Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and welcome to VideoCast 46 and Podcast 36 for the week ending September 4th, 2020. What a busy and exciting week we had. We'll start off with some of the media spots and content, and then we'll move right down to the subject matter. First of all, I'd like to thank Ellie Terrett, Cheryl Cassoni, and Liz Clayman for having me on the Clayman Countdown today to discuss what was happening in the markets, which were up before the open, then down 650 points on the Dow or something to that effect, then positive, and then they closed a little bit negative. The key thing that I said that they laughed at was welcome to the rotation, welcome to the reopening trade. And basically what's happening is a very healthy and positive thing moving forward. This is the beginning of the reopening trade. Effectively, what that means is that when people were anticipating slow growth, the country was not going to reopen, or you'd have mini shutdowns. Money would go into tech because managers had to chase those few small pockets that would perform well in a slow economic growth environment. And what you're seeing in the last few days with all the good news on vaccines, reopenings, economic data, etc., is that money is now starting to broaden out, and it's coming a little bit out of the high flyers that were bid up due to lack of choices to now that growth is coming back in the economy. It's moving into cyclicals and value. And one of the things I pointed out to Cheryl is the story that no one's covering this week. In the last 4 days, every single day, the bank index was up, which is, when pigs fly, we covered in our previous articles, previous week's VideoCast. So, was glad to be on with Cheryl today. Thank you so much to Ellie for having me on. The other thing that I pointed out was that the yield curve was actually steepening, which is a good situation for banks. Usually you'd think when you had this kind of turmoil, the money would go into defensive, into treasuries. It's not been the case. It's just moving out of tech and into cyclicals. Banks were the best performing sector today. Great to see. Thanks for having me on. Next, tonight, actually, this is why we're running a little late. Larry Menti, who's a legend. He was the host, first male host of Access Hollywood. He's done so many things throughout his career. He's got so many Emmys, he can't even fit it in one house. He called me up and sent me an email late in the day. He said he's filling in for Buck Sexton on the 710 WRR radio. Would I come and talk to him about the stock market? I've done a couple of TV spots with him. He's got his own TV show during the crisis, like in March and April when everyone was under their bunkers. And that was just so much fun. If you have time to listen into it, do so, because he asked some good question. How could the jobs report be so good and the market was, down so much today? And I kind of laid out the scenario for him that this is actually a really good thing because money is shifting now. You'll have some volatility in tech, etc. But definitely check that out. We'll cover some of the key points in today's VideoCast podcast as well. So thank you to Larry Menti. It was a lot of fun. That one was a lot of fun, so definitely check it out. Then earlier this week, I was on CNBC Indonesia, and this was a great interview. We're going to go into it in good detail in the article of the week. Wanita Aline Wiratmaja. I just called her Aline. Wanita Wiratmaja. Thank you so much for having me on. She was the host you see right here. She's phenomenal. And also Yolaiwan Haryana, he was the producer, and usually it's Maria Katerina who interviews me on this show. So I love being on with both of them, and this was really an in-depth interview, which we're going to get into a lot of the detail about all the entire world, from gold to emerging markets to inflation to Shinzo Abe to China, and it lasted 30 minutes. It was the full half hour of closing bell for CNBC Indonesia. So again, thank you to Aline and Yolaiwan for having me on earlier this week. Also want to thank Brad Smith for having me on his show. He usually hosts with Nora. I got to speak directly to Brad. Allie Thompson, I want to thank you for inviting me on. Jeff Cohen and Francisca Conte for also having me on. And we're going to go into some of the details of what we covered on Brad's show, on Cheddar. Then Devik Jain and Meta Singh, thanks for including me in your article also on Monday. And this is when, we were getting kind of that blow off with high value tech. And he was like, what's going on? And I said, basically what's going on is there are limited options where you can buy growth because the country is slowly reopening and tech does the best in a slow growth economy. So we've been talking for the last few weeks that this is going to shift on a dime, and it's going to be, we've used the word abrupt. MarketWatch picked it up, and what we saw was the beginning of abrupt. Apple corrected. I covered in 4 of these interviews on Monday and Tuesday how overvalued Apple was, particularly in Brad Smith's interview, and also one other I'm going to point out here. And sure enough, the next 2 days, Apple from peak to trough actually was down as much as almost 20% in 3 days after those 4 interviews. Sometimes better to be lucky than good, but we've been talking about this for a week or two. So thank you to Devik Jain and Meta Singh for putting me in your article. Then I was on Greta Wall's show, Wall to Wall, on One American News Network. Want to thank Greta Wall and Lindsay Oakley for having me on. And in this show, we covered a lot about Apple in that show. And we're going to get into it in this week. We also covered it in depth in last week's VideoCast. And we also covered stock splits and the implications of the Dow changes, etc. So thank you to Greta and Lindsay. Then we were also on CGTN Global Business with Rochelle Akufo. We will discuss a little bit of the point. This was predominantly concentrated on the China recovery. The reason I spend so much time on the China recovery is because they're about 2 months behind us. If you remember from our previous VideoCast, their cases peaked in February, mid-February. Our cases peaked in the epicenter in mid-April. So it's always very, very important to be on top of what's happening with the China data. And I also covered that on the radio interview with Larry Menti tonight. So you definitely want to check those out when you have some time. And then that is it for that. So thank you to Zaina Al-Shaib and Rochelle Akufo over at CGTN Business for having me on that show. Now, want to actually shift gears to the Ask Me Anything for this week. I got a lovely email message from a gentleman named Jared. I'll just call it Jared G. He says, I'm a rising junior at what this is. We're going to use this for Ask Me Anything this week. Each week we cover 1 or 2 questions that came in during the week. And if you're in the newsletter, you can submit questions each week. So he says, I'm a rising junior at Wash U in St. Louis, studying finance and economics and strategy. I'm currently going through the investment banking recruiting process with the goal of making it to a hedge fund afterwards. I look forward to hearing your podcast each week, as what I've learned from you comes up in daily conversations, interviews, and obviously my own personal investing. Much of the reason I want to go into the hedge fund industry has come from my interest in your investing style and balance of fundamental analysis with detailed market timing. While this is not a question of the week, I really do appreciate any time you may give this note. I want to know as a college student how I can best position myself to be successful in the industry. In addition to listening to your podcast, I read some of the premier investing books, your newsletter, and the news each morning. I try to apply the principles I've learned from you throughout the week and compare them to what I hear on Fridays. As I reach out to those in the industry, it has become clear that I want to work in a more fundamental active fund than in a quant fund due to the art that comes along with intermediate long-term investing. I appreciate any guidance you may offer. Thanks so much. So great question, great email from Jared. For any of the younger people listening in, this is the way that you approach someone. My hat's off, and this guy's going to be successful no matter what he does. Now, let me answer his question. I was back and forth with him this week, but I want to answer it for everyone, and hopefully it can make a difference here. There were a few things that I suggested to Jared. The first and foremost is you should read the book that Warren Buffett recommends as his favorite book, called The Intelligent Investor by Benjamin Graham. This is probably the most important book, in my view, in the investing business. There are actually two schools of investors. There are growth investors that will read the William O'Neill book, How to Invest in Stocks, and they have one particular style. That's more individual traders, because when you're managing large amounts of money, you can't, be buying breakouts and that type of thing, and then, stopping out when it's a failed breakout. So, larger institutional money tends to buy value. There are different variations of value, but so that they can build a position over time and then start to sell when it's fully valued. But definitely, I would read The Intelligent Investor by Ben Graham at least, 100 times, but start with once. You should also get a copy of Seth Klarman's Margin of Safety. I know online this has, been sold for $2,000. Reach out to me. I might have a copy of it. I can get over to you. That's another good book. But the Buffett one is the most important thing. The third one is probably the most impactful thing that I ever did in my career, and that is to read 100% of every single letter to shareholders that Warren Buffett has ever written. You can just go to BerkshireHathaway.com. Every single letter to shareholder he's ever written is on that website, and that will give you more education, more understanding of business investment than anything you'll ever do in your career, and 99.9% of managers never do it. That's number one. Number two, you can even go back to the letters when he was a hedge fund manager. You'll have to dig a little bit to find them. If you have a problem, reach out to me and maybe I can help out with that. And then the last thing, and this is something that no one will do, but this is very valuable, and I posted a picture of Warren Buffett with his beat up Value Line binders behind him in his office a couple weeks ago, that we saw on Twitter. What I would suggest, I think you can get it at most public libraries, or you can subscribe. Go to valueline.com. They have tear sheets of every company that they cover. It's about 2,000 companies, predominantly US-based companies, and they do a one-page tear sheet that has all the financials for the last decade and a half. It has, 5 or 6 paragraphs about what's happening most recently, has a little overview of the company, the balance sheet, the income statement. But in one page, you can get a snapshot of a company in 5 minutes. You can study it, and you can start to get a feel for gross margins of different businesses, growth of intrinsic value over time, etc., based on the industry. And they also have sector overviews. So my suggestion would be to study 5 companies a day from Value Line. Within a year, you'll be well ahead, and you'll just have a really good understanding. The one thing Buffett said, he can do a deal in 5 minutes, but the reason he can do a deal in 5 minutes is because what he knows and has experienced over, multiple decades. So it's the same thing with building that core understanding. Learn all the companies, learn all the sectors, see how they operate, and things trigger other things in your thinking process. So it's like a domino effect. I strongly urge that. You can probably get each edition for free at your public library. I think some public libraries will give it to you for free online, or you can just get the subscription, which is a modest amount of money. But I strongly urge you to do that, Jared, and anyone else listening that wants to know. So the 4 points are every Buffett letter, the Intelligent Investor book. If you want to go crazy, you could do Security Analysis by Ben Graham as well. Seth Klarman, Margin of Safety, if you can get a copy of it. And go through 5 companies a day on Value Line. Over the next year, you'll know more than 90% of managers in the business. And then from there, you can see if you love the business or not. The key litmus test for whether you think you want to be in the hedge fund business or money management business just because you want to make a lot of money, or because you love it and you eat, sleep, and breathe it, kind of like I do. Sometimes, this week, and people are like, oh, you're working so hard. I don't really, it's hard work, but I don't really feel like I ever work a minute doing this. I absolutely love it. So if you read that book and that's the way you feel, then you've got the right industry and you can't make any mistakes. And you have my cell phone now. You can always reach out, Jared, and I'm happy to guide you along the way. But that is, I hope, helpful. So that is the Ask Me Anything for this week. Now, last week, I talked about an article I was in with Devin Pendleton and Jack pitcher where I was pitted against Bernie Sanders saying that I'm not sure that we should allow billionaires to make money. And then I said, when you look at Musk and Bezos, it's easy to understand that in their own ways they've changed the world. But I also said that, laid out the context of what I discussed with Devin, and she obviously couldn't fit it in the article because she's limited on space. But I said, don't worry about, the context was Bezos and Musk's net worth hit 100 billion and 200 billion each. And what I said to Devin was, don't worry about how much money they made, okay? It's equivalent to the value that the market perceives that they have created in the present. But the market will take care of that analysis and estimation. So either the market will get tired of paying so much for future earnings, or the competition will enter and erode their business, or you'll have exogenous factors like antitrust. And the point that I made to Devin when we spoke on the phone, and she was lovely, was that no one cared when Amazon stock fell over 90% in the early 2000s and he lost 95% of his net worth. But the underlying fundamentals of the business were still performing. So again, just as it overappraised him initially in 2000, it underappraised him, the market did, underappraised the value of his enterprise in 2001, 2002. And, some would say recently $200 billion is too much. Well, he just got a reappraisal this week. And, this is a week ago I was saying that. And sure enough, Bezos, Musk, and Zuckerberg lost a collective $25 billion in net worth after the tech stock fall yesterday. So will this persist or not? It's immaterial. The bottom line is, we know that success attracts competition. And what are we seeing? We're seeing, when I was talking with Rochelle in China, we were talking, not with Rochelle, with BBC, we were talking about Alibaba and how Aliyun is growing like 3 times faster than its domestic counterparts in the cloud business. So eventually margins will be eroded. If that doesn't work, certainly with Elon Musk, there's a SPAC every single day. There's a SPAC by the former Speaker of the House. Like the guy, great, good for him. Oh, and then the former chief of staff is starting a hedge fund for banks. Like these guys have never done anything in finance or business. Everyone's got a SPAC. So, there's 30 electric car vehicles. All we need to see next, please don't do it. Larry Kudlow, do not leave the administration to go start an electric vehicle SPAC. We've got enough. So they're coming for Elon's net worth, but no one can really match what he's done. But the market has reappraised him. So he took a hit. Zuckerberg took a hit. Gates took a little hit. And that's why Bernie Sanders, God bless him, he doesn't have to stay up all night and worry about whether or not he should allow billionaires to make money. The market will worry about that. And if the market decides, like they did in 2001, that they're overpaying for the future value of Bezos' enterprise, they'll mark it down 90%. I don't think that's going to happen, but I'm just saying that they have to face this competition every single day. And then what happens is when that doesn't work, you get situations like, here we go. Justice Department could launch antitrust suit against Google as early as this month, reports say. So, you have problems like that. Microsoft went through it for 10 years and they got hammered, but their underlying business kept growing. They missed mobile because they were distracted with it. So these things happen and the market takes care of it. So not to worry. And we saw that, a week after. I'm getting pretty lucky with the timing of some of this stuff. 4 interviews on how Apple was overvalued Monday and Tuesday. It drops 20%. And then not to worry about Bezos and Musk's net worth because the market will take care of it a week later. Boom. So, but, this is not brilliant insight. Anyone that's been around for more than 5 minutes could make the same assertions and, understand that these things come in waves and the value that they've created is substantial and it'll vacillate based on market appraisal. So thanks for that. Want to cover a couple random items before we get into the article of the week. Hedge funds unloaded tech and healthcare stocks. Here's what they bought instead. So it's starting to sniff out the recovery and the reopening trade that I talked about on Fox Business today. Billionaire Dan Loeb bets on COVID vaccine arriving this year. Here's what it means for your equity portfolios. Now, this is very interesting. This article came out today, actually. We've spent a significant time with scientific experts. This is a letter that he wrote to his shareholders. Now, Dan Loeb, he's done 20, 30% for a couple decades. He's a solid, steady, built a huge business, hedge fund guy. And he said, we've spent a significant time with scientific experts to better understand evolving treatments and vaccines and have confidence that several will be effective and available later this year. Our equity portfolio is balanced between companies that are doing well now, i.e. tech and growth, and you've seen the reports in recent, and later stage recovery names in aerospace, entertainment, retail, which are still trading near their March lows and should benefit when there's a move back to these sectors. So we're just seeing more and more things pointing to this cyclical rotation. We saw it in the Bank of America Global Fund Manager Survey last week. Managers were saying they're moving into value, they're moving into emerging markets, banks, small caps, etc., and they're starting to get ahead of this. And today is where, it only takes a sneeze, one guy trips up, and then, and then the whole rotation starts to happen. So I think this is going to be in fits and starts over the coming weeks. I think tech probably has a bit more to work out over the next few weeks, and it was nice to see banks finally getting bid the last 4 days, and it's really a sign that the best is yet to come moving forward economically speaking. This was high frequency data from JP Morgan. Losing the extra $600 unemployment benefit may not have stopped Americans from spending money, JP Morgan credit card data show. This was really positive to see because when the $600 expired in August, credit card data continued to increase. Eventually, President Trump did the executive order when Congress was withholding money from the people who needed it the most. And so he's got that 300 out. And that's, by the way, the exact inflection point when he turned in the polls. Like, he was losing big, and now he's running neck and neck with Biden. And you could just trace it right back to that day. He checkmated by caring more about getting the money to the people than the politics of it. And that was a huge deal. And it's really changed the election dynamic. A lot can happen between now and November, but you can just look at that date on the inflection point. Executive order, boom. And Congress handed it to him. I mean, had they passed it, they would have been the heroes. So now they're not, and they got to go home and face their constituencies. So good luck with that. Next, mortgage demand from home buyers is now at 28% higher than last year. So look, I mean, this stuff just keeps coming. Fauci was out this week saying that, was it Fauci? CDC tells officials to be ready for a vaccine by November. That's why this is becoming real. I've talked about it for weeks. The vaccine is going to be the catalyst. Don't bet against science. Don't bet against science. It's here. AMC says 70% of its U.S. circuit to open by Friday, September 4th. This is huge. People are putting on masks and getting back to their lives. Carnival Corp. Costa Cruises brand to restart their operations this weekend. They're going on cruises. Okay? What else is happening? Apple lost $180 billion in market value on Thursday. It's the biggest loss for any company ever. Now, this is kind of interesting because last week we went on this huge rampage about Apple, the most loved versus the most hated stock in the S&P 500. And we said, okay, because Apple is an established company, it trades on earnings power. The average current PE multiple on earnings since 2004 has been 16 times earnings. If you apply the average multiple to 2020 earnings, you get a price of $207.52, which now it's the 4-for-1 split, so it would be $50 and change. If you apply the average multiple to 2021 forward earnings, you get a price of $248. So that, you're looking at 60 and change, and it traded as high as 515 a few weeks ago. So call it 120, 130 and change, implying a 39 times earnings multiple on 2020 earnings, or 38.18 multiple on 2020 earnings. 2021 earnings. This compares to an S&P trading at 21 times 2021 earnings. Now, here was the key point that I made on the 4 interviews and in the letter last week that you guys heard. Over the past 10 years, the highest multiple Apple has ever traded at prior to now was 24.62 on current year EPS. We're at a multiple that's 61% higher than it has ever been. It was at 39.7 when we were doing this last Friday and on Monday and Tuesday interviews, and which would make sense if the earnings growth rate was going to be faster than it's ever been. But with a $2 trillion market cap, the law of large numbers makes that improbable. If you compare that to the lowest multiple Apple's ever traded at in the last 10 years, 9.25 times current year, that would put its current price at $119.97. That's pre-split. So that would take it down to, divide by 4, $30 bucks or something like that. A far cry from whatever it hit, $130. Let's see, $134.67. So that was pretty timely. And so what I was basically saying last week was, since neither of these okay, we talked about Wells Fargo. So with Wells Fargo, we said over time, a reversion to the mean, the middle range of multiples is realistic. That would imply 1.25 times book for Wells Fargo, or a $48 stock. It would also imply 16 times current year EPS for Apple, which would imply a $248 stock. So divide by 4, $60 and change stock. We're still over 100. I don't think it's going to revert that aggressively in the short term, but that was the math behind it. It's a spectacular company, but the math doesn't support further multiple expansion in the intermediate term. That was the case, and that played out. And we also saw banks getting bid this week. Now, after the bell, we saw that Warren Buffett dumped Wells Fargo. All I can say is, at this stage, number one, Todd and Ted are running a lot of the book. I mean, Warren hasn't done a lot of international investments. He did the 5 Japanese trading companies. That's new. These guys did Restoration Hardware. They did Amazon, which was down big this week. They did Apple, which obviously was down big this week. So look, nothing's perfect. They're investing over the long term, and they felt they could get better returns in the long term by cashing out of Wells Fargo, or they needed the money during the downturn when they didn't know what their insurance exposure was going to be. Look, I would rather Warren Buffett was a buyer of Wells Fargo if I knew it was Warren Buffett, not his lieutenants, because they have a different skill set and a different style. But the bottom line is his insurance business generates so much float they could just stick it in an S&P 500 and they'd be crushing it. So that's where that's at. And very positive developments on both fronts there. Let's move on to... we actually got an upgrade today from Dick Beauvais. Dick Beauvais is a analyst who's been around for decades, a bank analyst. And his thesis was a very smaller version of what we've been talking about in recent weeks. He upgraded to a buy from hold, pointing out that for all the bank's travails, still the largest private housing lender in the midst of a U.S. housing boom. Hello. That's not going to stop anytime soon. Just open your newspaper and see the bidding wars. It has a new management. It has tens of millions of customers. It has trillions of dollars. It's going to succeed, Beauvais. This stock does not recognize this. It should be bought. Wells Fargo is trading at a 62.6% of book value. We've been talking about that 38% discount to book for weeks. And in the past 30 years, quote, the stock only sold below this level in 2009 and 1992, which, if you followed us, we've been saying that for the last month. Still, maybe he listens to the video. Hi, Dick. Anyway, still the company remains a formidable presence with $159 billion in common equity, the 4th largest amount in the banking industry, $1.4 trillion in deposits, with $412 billion of that non-interest bearing and $935.2 billion in loans outstanding. So that was really good because sentiment is finally shifting. The market's starting to get it. And the government needs to wake up. This recovery is going great. You did unbelievable things. Lift the asset cap on Wells Fargo. If any administration people are listening, banks are, and I covered this on Larry tonight on the radio show, Larry Menti's radio show. where he was guest hosting, lift the cap. It's a new management. There are no people left that were involved in the aggressive sales practices, which, by the way, I think if Buffett's involved in the sale decision and it's not his lieutenants, I think it's a legacy thing because he almost destroyed... Solomon in the early 90s almost destroyed his lifelong reputation. Like, that was the big taint on his whole career. And now, as he's in his, later years, he doesn't want to have any taint, and he doesn't deserve any taint because he's one of the greatest investors of all time. So he's probably dumped out of that so he can just say, I wasn't unsure about their past practices. I didn't want to be involved. And I completely understand that. I mean, at his, reputation is extremely important, and legacy and all of that stuff. And I think that might have a lot to do with it in this case. But all of that stuff is in the rearview mirror. No one that was involved in the sales practices and upper management is still in the business. CEO's out, CFO's out, COO's out, everyone's out. Charlie Scharf is turning the business around. They're doing technology, and they're going to just ride this millennial housing boom for the next decade, and it's going to be phenomenal in my view. So that's that. And the market started to get it this week as well. We had a huge inflection. This is Wells Fargo to Apple, most hated stock in the S&P 500 to the most loved stock. Complete turnaround, overnight turnaround in this ratio chart. Same with the bank index to the tech index. It just completely, it's like, the ink wasn't even dry on these interviews, and it's just taken off. And this was overdue. And look, maybe it'll be fits and starts, and half of the people listening are saying, it's another fake out, you sucker, watch out. And maybe they're right, but I think we're getting too close to the vaccine, and I think it's going to be a game changer. And I think these valuations that we've laid out, both on the low side and the high side, tale of two markets has been our theme the last few weeks, need to be taken seriously, and now it seems they are. The other thing that was critical, and I covered with Larry, and I covered, I think, with Cheryl and one other, was what was interesting about the sell-off the last couple of days is that people usually plow into treasuries, but what happened instead was yields actually increased on the 10-year today, even during the worst part of the day. So the yield curve steepened, which helps the banks, which just tells me this is a reopening trade, and there's some leverage and some people getting caught off sides and some margined up retail people, etc., that are just getting a little bit shellacked here because they had all their money in a few growth stocks or SaaS stocks or Zoom or Tesla or one of those, and they just got smoked. So that happens. It happens all the time. Here's the yield curve steepening thing that we've talked about for the last few weeks. Green is the XLF financial ETF. You can see that it peaks when the yield curve is flat. It's come all the way down, and then it bottoms after the rise, and then once you see that yield curve steepening, then financials take off, yield curve steepens, financials take off, and then here we bottom, yield curve steepened, financials are starting to take off. So that's even gotten better this week despite the sell-off. You would think there would just be too much money to go back in treasuries. This would flatten again. It was not the case. That's good news. This was the Apple sell-off after the Monday interview and the Friday podcast. This is the article of the week. Okay, so the Run DMC, it's tricky stock market and sentiment results. I actually loved this song. When I was growing up, I spent 90% of my days on rollerblades playing hockey when I wasn't on the ice. And I had a friend down the street named Brian, and we would actually sit in front of, for those of you in your 40s, you'd sit in front of MTV and wait for your favorite video to come on. You didn't go to YouTube and just find it. So this was our favorite song. It's Tricky by Run DMC, and certainly catchy. But I never really understood the story behind it until this week when I started researching for the article. And the lyrics themselves are self-explanatory. It's tricky, 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 ha. And I'm doing that in the context of embodying the current status and sentiment of the stock market. But it's the story that fit the bill. That was the magic thing. Now, this was written on Wednesday night before the market rolled over. And if you remember on Thursday morning, futures were up before the open. This goes out at 7 a.m. And right after I get the sentiment results. And So the music video features, this is Penn and Teller. They are a legendary magic duo from Las Vegas. They've had a show for decades. And what they were doing in the video was hustling a group of people in a game of three-card Monte in front of the Rialto Theater in downtown Los Angeles. Now, basically, they wind up taking this lady's necklace because they say, oh, you can win your money back, just put down your gold necklace, and they scam her with the three-card Monte, and she loses her necklace. So she calls her friends, Run DMC, they fly in on their helicopter, and they basically hustle the hustlers, and they just start winning all the hands, and that's the video. Now, my sense was, and this is funny because it was like the day Tesla was peaking, I said, my sense is that Tesla is selling $5 billion of stock to the public after a parabolic move up, trading close to 12 times sales, maybe a little bit like Penn and Teller taking money from the untrained spectators in front of the theater. I'm a fan of Elon Musk. He's changing the world in numerous ways, and he's not to blame for the valuation, but this feels a little bit excessive. And sure enough, it rolled over the next day. So, you know, it's not just Tesla, and Tesla may keep growing, and et cetera. I think their business will keep growing. I don't know if their valuation will or it won't. It doesn't matter, but it's just overheated for now, and the market has finally reappraised it in the short term, and we'll see what happens over the intermediate term. But brilliant guy, brilliant business. He's going to keep succeeding in everything he does. It's just a question of how much it's going to be valued. And Bernie doesn't have to lose sleep all overnight deciding how much he thinks it should be valued. The market will decide, and that will be fair enough. So the inmates are running. So the inmates are running the asylum. I did this with Larry as well. And so while Tesla was overdone in the short term, the leader of the pack is Zoom. So Zoom has certainly changed the world. It came in handy during this crisis. It's become a thing. It's like the Kleenex of video conferencing. My guess is you could get a team of developers in Asia to put this thing together, like the same technology, for probably about $50,000 to $100,000. And people are going to say, "Oh, you're crazy." Okay, so what if it's $1 billion? The company's now valued, or was valued before when this article was written, at $126 billion market cap. This is a video app. We've had a video app called Skype. We've had a video app that's free called Google Hangouts, Google Meets. There's a lot of different ways to do this. So it's traded after earnings, and they grew revenues. Revenues are up 9x in the last 8 quarters. So they went from 75 million to 664 million. That's a good thing. The issue I had is that it's trading at 63 times sales, so you have to live another 63 years to benefit from what you're paying for now, and 287 times 2021 earnings. So what you're basically saying here is we have a monopolistic moat that no one else can replicate, and it's going to continue to grow at this pace in perpetuity forever, in which case it would be bigger than the GDP of the world. Unlikely, and I think the market figured that out in the last 48 hours. So I'm surprised they didn't do a secondary offering with Tesla. So that's that. And I wish them continued success. I use Zoom. I think they're going to continue to succeed. I think that the market will just put a different valuation on it, which will be fine. And they'll continue to grow, and they'll continue to provide a tremendous service. And that's the same for all of Elon Musk companies as well, which are changing the world. So it's not in any way a commentary on the business. It's a commentary on the short-term valuation. Got a little out of hand. You leave a bunch of 25-year-olds with stimulus checks and Robinhood accounts, things get a little crazy. It's just the way it is. And that's how we all learn, by the way. We all start doing that, and that's a good thing. It's not a bad thing. So, okay. So that's the inmates running the asylum. On the Brad Smith thing, we covered, on the Brad Smith interview, we covered the Tale of Two Markets theme, which we've gone through. You can review the last 2 weeks' notes, but I'll just go into the Lionel Richie note from 2 weeks ago. When people were saying the market's toppy, I said, okay, do these sectors look toppy? For instance, this was banks at the time, okay? Do those look toppy? No. How about energy? Does that look toppy? No. How about defense and aerospace? Does that look toppy? No. Casinos and airlines, does that look toppy? No. And guess which stocks were up this week? when tech stocks were down, all of these, casinos, airlines, defense and aerospace, energy, and banks all held up the best. And all of these, where I put together a basket of semiconductor, tech, and internet stocks that did look toppy, they all got shellacked. So this is the note from 2 weeks ago. You can review that. That's what I covered with Brad. He also asked me some stuff about the vaccines, about whether people will take it, about the election, which we've covered, what it would mean to have a blue sweep, which is no longer appears to be in the cards. 3 weeks ago, it looked like a possibility. Now it really looks like we will have gridlock, and gridlock's really good, and meaning that we will have at least one house controlled by an opposing party, which is of paramount importance because that means they can't get the corporate tax increase through. We've gone through the implication of the corporate tax increase from 21 to 28%. David Kostin's done the math from Goldman Sachs. You'd lose $20 of earnings from the S&P 500. You get a lowered multiple. You'd probably get a 20 to 25% correction re-rating of the stock market if that corporate tax went through. What do you need to block it? You just need one party of the opposite color, and it looks for sure we're going to get it. So 4 weeks ago, it looked like blue, 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 executive, Senate, House. Now it looks closer to like it could be, red, red, blue. It could be red, blue, blue. It could be blue, red, blue, but it's not going to be blue, blue, blue. I mean, anything can happen in 2 months, but it'll be gridlock irrespective of who's president. That's a good thing. Corporate tax rate rate's the same. Bullish for the stock market. Ideology and all that other stuff, leave that aside. This is a stock market podcast. I'm just telling you what impacts the stock market. Not, make your own bets on what's important about social and other issues. Speaking of which, I was on One American News Network with Greta Wall. We covered why the tech stocks were doing well and what would cause a rotation. And literally a day later that happened. We also went into the valuation of Apple. And effectively why tech stocks were doing well is because in low growth environments, there are very few places that you can get growth. Low economic growth, are very few places you can buy growth. That's tech. Now that we're doing the reopening trade and we're reopening the country and we're close to a vaccine, that's why you're seeing all these cyclicals start to step up, because they're going to grow really fast in the early part of the cycle, like happens coming out of every single recession when economic growth is abundant. M2 money supplies increase 25%. We're going to get 6.5% GDP growth next year. We haven't seen that in decades. That's when cyclicals fly, banks, defense, industrials, etc. And what does that mean? It means supply and demand. There was a dearth of growth. That's why people were paying 287 times earnings for Zoom. Now there's going to be a plethora of growth. Banks are going to start growing, industrials, defense stocks, all the laggards that have been left behind. Airlines will eventually come back. Cruise lines will eventually come back, which Cheryl wanted to talk about today. We did talk about airlines today on Fox Business. So that means that growth stocks will now be competing for dollars, whereas as recently as a week ago, there was no competition. There was a handful of real growth, and all the money went there, and now that's re-rating and changing. Now, in the Wanita Wiratmaja interview, Aline's interview on CNBC Indonesia, this was a half hour. I strongly recommend, because I really go into the nuances that we're not going to have the time to do this week of every aspect. So which parts are undervalued and overvalued? Is there a disconnect between the stock market and the economy? Most loved versus most hated. You got that in last week's podcast VideoCast. Is rotation coming? What will it look like? It came this week. It started this week. Outlook on emerging markets in Indonesia with the weakened dollar and the demand for commodities positive is the Cliffs Notes version. China stimulus data and recovery update. I covered a lot of the data points from Rochelle's interview in this one. Buffett's bet on Japanese trading stocks and what that says about his commodity outlook, etc. Shinto and its potential power shift between China and Japan as a lead exporter. That was a real interesting nuance that you may want to catch. She also asked about September seasonality. Historically, it's bad. In election years, it tends to be flat to slightly up, so we'll see if that holds true. We went into a lot about the election and what Wall Street would like to see. Gridlock is good, etc. We just covered that. We went into the gold example. A lot of interest in gold because of inflation expectations. Basically, I just laid out what Buffett did in his 2018, I think his letter, and that was that if he invested $10,000 in gold in 1942 or $10,000 in an S&P index fund in 1942, by 2018, the gold would be worth $51 million. The stocks index would be worth $51 million. The gold would be worth $400,000. So if you used gold as a hedge against inflation versus stocks, it would have cost you over $50 million to make that decision. Could gold double or triple from here? Yes, but over the long term, stocks are going to outperform because companies have pricing power. Certainly when we're dealing with the top 500 companies in the world, in something like the S&P 500, they have pricing power, they have moats, and they will outperform as an inflation hedge over time. So that was the message there. Nothing wrong with gold if you like it. People are using it as a proxy instead of treasuries because they think all the yields sucked out and they're not going to work the same. There was an article this week that Bridgewater is now using gold and tips instead of treasuries in their risk parity fund. So, that's one group's point of view. Next, if you want to get a sense of what's happening with China, their seats in the air are getting close up to pre-pandemic levels in terms of domestic airline flights. Their manufacturing is galloping. The stimulus that they've done with they did $500 billion of stimulus, but they're doing a ton on railway, power lines, and EV charging stations. I think that's really valuable. I'm sad that we didn't use some of this money in investments that would get a long-term return. It was kind of a political mess and also urgent to get the money out. Hopefully in future, if there is a future package, they try to get some of this long-term investment that will benefit generations to come, like what they did in China. And the other thing that I think may be starting to weigh on semiconductors, China has a Made in China program where their goal is to have 40% of their semiconductors made domestically by the end of this year and 70% by 2025. So, we may see a shift in weighting of sectors moving forward. And we're going to talk about that as far as earnings outlook in just a minute. So, in last week's note, one of the key points I made is that most people would say Wells Fargo will outperform Apple on a relative basis when pigs fly. Well, they were flying this whole week, I think both yesterday and today, and hopefully this trend persists. So I tweeted a pig flying with, Wells Fargo outperforming by 6 points at that screenshot today. I think it was as much as 11% differential in one day, at midday. So, a few days don't make a trend, but I think we're getting close enough here that people are waking up. The other thing that was interesting this week was the AAII sentiment is still bearish. I mean, not bearish, but like neutral, 30.8. It went down from last week. So there's not euphoria among individual investors. Maybe they had it right in the short term. Fear and greed was close to extreme. It didn't quite get to 80. And the active managers were at 105. That is an extreme. It doesn't necessarily mean that you get a crash, but certainly we got a let up here. And my message was basically, I don't think you're going to win, quote, calling the market in coming months. I think the opportunity is in finding long-term value and pouncing while at the same time peeling off the runners that made you big gains in recent months. So hopefully you guys were able to do that in recent days and weeks, because that was our similar message to last week. And I closed out, it's not binary, it's tricky, like the Run DMC song. See how that works together? Okay. So this is one thing I wanted to cover. In addition to the thesis being aligned with cyclical starting to outperform, earnings estimates are aligned with cyclicals outperforming. This is from FactSet today. This is the expected calendar year 2021 earnings growth by sector. And you see the leaders. Our energy actually has. I couldn't figure out why energy didn't have any numbers for the last few weeks. It's because they had no earnings like recently. They were negative earnings, so you can't really have a percentage gain on negative. So, but energy is going to have the highest percentage earnings growth, followed by industrials, consumer discretionary, financials, and materials. Those are all going to have higher earnings growth than the S&P 500, which is going to grow 26.3%. Infotech is going to grow at half the pace as the S&P 500. So if it's going to have half the earnings growth of the S&P 500, why was it getting as much as double the multiple in recent weeks in certain pockets? And now you know that it was because of speculation and euphoria in those pockets, but it doesn't tie to earnings growth that is expected because they've pulled a lot of that growth forward. All the kids who bought MacBooks and iPads for homeschooling, etc., and all the computers and widgets and everything else, they're not going to be repeated to the same extent next year. Semiconductors that go in all that stuff as well. So that's the story. Earnings are still going up every week, which is pretty good. I think they're at $166. Last year we did $163. So anyway, I don't have that. Earnings growth will be 26%, which is fantastic. And lastly, just a couple economic data points. We had just knocked the cover off the ball on the jobs report today. 8.4% unemployment. If you remember, a couple months ago I said we can get to high single digits by the end of the year. Well, we got to mid-ish high single digits already, which is just amazing. 8.4% unemployment rate. We've regained half the jobs lost through the pandemic. 1.37 million non-farm payrolls increase. Average hourly earnings are going up 4.7% year on year. This is because the government programs are rolling off. Employers need employees. They have to pay up. They're competing with some of the government programs that are still paying a lot. Average hourly weekly hours are up to 34.6. Everything is healthy about this report. It's a great thing. See a little wage inflation. It helps everyone. I think that's going to continue to increase. I think wages at the low end were really starting to increase in this administration. Pre-COVID, they're going to increase more because we're starting to grow. So, and we'll have 6.5% growth next year. It'll be amazing. Okay. Just got to keep that corporate tax rate where it is, regardless. We just need one of the three boxes to be a different color and we'll be good to go. So initial jobless claims came down. Continuing claims dropped to 13.2. That was good news. Crude, another huge draw in crude, 9 million barrels. It's crushing it. Again, this is just, you're going to wake up. This is going to be another abrupt move. You're going to wake up at some point in the next 18 months and WTI is going to be at $60 and oil companies are going to be double from where they are. But no one believes that. So just quietly pay attention. Start with the highest quality. Like I said on the show with Cheryl about airlines, got to start on the highest quality now when things are risky. As we get the vaccine, as we get things, you can move into some of the lower quality laggards. And again, this is all opinion. I don't know what your situation is. Read the terms on hedgefundtips.com. ISM manufacturing crushed it, not only in expansion, the ISM manufacturing PNI, but it beat expectations of 54.5. It came in at 56. That was up from 54.2. Again, all you need to do is look at the Citibank Economic Surprise Index, which measures the percentage of economic data that's beating consensus estimates. It's at all-time record highs, and it keeps staying up there week after week after week. So good things are happening. It's been a slog through the last few months for many people, but there is a light at the end of the tunnel. We're starting to see it. We will have the vaccine. Treatments are getting better. People are getting on with their lives, wearing their masks, and you're just seeing it in the economic data. So with that said, to leave it on a good note, thanks for listening in. If you have some time, I'd highly recommend some of those interviews. Were very granular and nuanced. You could basically make another half hour and go into some of the detail on that. But until next week, we'll be back same time, same place. Hope you found that helpful. Have a great long weekend. Enjoy, relax, and take care.